Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.
Hello and welcome to Nirmal, ladies and gentlemen. I'm Hiral. We have with us Mr. Devendra Kumar, Chief Economist at India Ratings and Research, joining in. Welcome to the show, Mr. Pant. All of us have been looking at the kind of action the RBI has taken so far already with regards to where the stimulus package goes, or with regards to where the kind of rate cut that they had provided. And the fair anticipation this time also was that the RBI is not really going to resort to any rate cut. They are going to take a pause, and that's exactly what has happened. Now, what's the sense that you pick up? Because the repo rate remains unchanged at 4%. They've continued with regards to where the accommodative policy stance goes, as long as it is necessary to revive growth and mitigate the impact of COVID-19 on the economy. And you have the reverse repo, which remains unchanged at 3.35%.
Yes, look, the RBI's job is bit difficult. Unlike most of the central banks where there's just one target of inflation targeting, RBI wears various hats, and at times there are some conflicts of interest also because being the tech manager, so he has to keep an eye on that also. But end of the day, the financial stability, price stability, and inflation is the topmost priority. Now, we were on the of that camp where we were expecting, or our assessment was RBI should hold rate, and the regions are as follows. There is no demand in the economy. In a normal circumstance where the jobs are not lost, economic activities are taking place, cut in interest rate can give some fillip or some boost to the demand. But in the current scenario, where there is a jobs and are lost, economic activities are not back in normal. Even those who are in the job, many people are not getting salaries. Now, in that situation, a rate cut would not have given any great benefit. On the contrary, if the rates were cut today, then whatever little monetary space RBI has, that monetary space would have been wasted. On the contrary, what RBI has been doing, and that they have been doing from a long time, and especially more from the 27th March, they are flooding market with the liquidity. Gone are the days when we were looking at the tight liquidity conditions, because the moment they move from the neutral to accommodative stance, the accommodative stance simply means there will be ample liquidity which will be available in the system. And the ample liquidity is the one because of which we had seen the pass through of interest, the monetary easing to the ultimate consumers. So that portion is continuing, and the way we are looking at it, still we are having a surplus liquidity of somewhere around 6 lakh crore in the system. With the limited demand, the only demand right now is coming from the central government, state government for their deficit financing, and some of these public sector enterprises, things like what we had seen, the NABARD, NHB, etc. They have given liquidity windows, they will borrow more. So it is mainly the demand from those and the big corporates, which otherwise have the financial muscles or financial strength to borrow even at a slightly higher rate. At this point of time, when we are looking at no personal loan demand, the housing loan demand is low, so a rate cut at this time would have not yielded result, rather than if that same rate cut is given at a time when the economy is coming back to normal, it starts moving, and at that time you give this as a catalyst, then you will have better.
Mm.
Result.
Mm. Right. So, do you think, Mr. Pant, that the RBI has further room with regards to where rate cuts go if you have to take calendar year 2020 into consideration? And if yes, whenever it is required, what the extent do you think is possible in the form of a rate cut? Do you think there is room for 25 basis points from here on, or do you think they could even extend it to another 50 basis points?
Yeah, look, as I said earlier, the monetary space is very limited. So at max, you can have one or at max two, not beyond that. Because if you look at it from the point of view of savers, all right? When we are talking about all those money, liquidity in the market, from that money is coming. That money is coming from the savers. And if you look at national accounts from the institution wise, it is the households, those who are the net savers in the economy. And it is from that savings, the money is being used by the other institutions, which are corporates or the banks or the government. Now, even if I look at the real interest rate and repo minus real interest rate, let's not look at the headline CPI. Even if I look at the core CPI, even then we are somewhere in the negative territory. A negative real interest rate means we are penalizing a lot to the savers. Now, if savers are not incentivized, right, whether you want to have 25 bips or 50 bips as a positive interest rate, or whether you want to have minus 50 bips for the as the negative real interest rate. Because if you have the negative real interest rate, all incentives for savings will go away. And in that situation, it will be problematic.
Right. So, Mr. Pant, if you're talking with regards to where real interest rates are concerned, now, let's take into consideration the current CPI inflation, which has been in the negative territory at least for the last 6 months. But now, if you have to look at 1 year ahead estimation with regards to where inflation is concerned, it is still in the positive territory by at least around 50 basis points. Taking this into consideration, is it then right to say that a further 50 basis points by the end of 2020 could be expected as the inflation trajectory eases from here on?
If you look at the forward looking, yes, there is. So that's why, as I said, that there is only a scope of 25 at max, 50 bips, not beyond that. The inflation expectation, we have to take it, look at that number carefully, because what is happening is, even in the past, you see, the inflation expectation is mostly based on the prices of the commodities which we face every day. Say, for example, the moment onion, tomato, or potato prices are high, because this is the inflation we face at least 3 times a day, breakfast, lunch, and dinner, our inflation expectation shoots very high. The moment these prices comes down, our inflation expectation will not come down at the same proportion. It will come down at a faster pace. Similarly, the one who is facing the heat of the high oil prices, despite low global prices, but high pump prices of retail prices, the expectation vary. Now, it's a good tool, inflation expectation. One can use it more for the direction rather than the magnitude. But all in all, I think not more than 50 bips is what is the space which is left with the RBI for the monetary easing. And that it should use judiciously at a right time.
Absolutely. The timing is something which really needs to be correct from here on, because transmission is something which is still lackluster. With regards to growth as well, Mr. Pant, for 2021, they've said that the real GDP growth is expected to be negative, and that's something which is a given right now. What are the kind of numbers you have put into your estimations, right? With regards to where GDP is concerned?
Look, our last we had our last forecast was around we did it around middle of June, and our forecast was suggesting all 4 quarters having the negative growth rate, with the first quarter growth rate somewhere around -15, and then that contraction started going down, so less of contraction. But what has happened is uh, the scenario of wider spread and localized lockdowns has increased. So what we had seen, whether we look at the Google mobility report or Apple mobility report, it had shown good improvement in the mobility between April and May, and sequentially from May to June, the mobility has increased. But if you look at mobility in the month of July, it is not very different from month of June. Same if one looks at how the power production, daily power production has behaved. Now, daily power production will have a lot of variation because of the weather-related issues. Uh, and if one smoothens it out on the fortnight basis, so what happened? Again, we had seen the first quarter, first fortnight of April onward, the power production has improved. So somewhere around -25 to 30% to June, it has come to somewhere around minus 8 odd percent. But in the month of July, again, sequentially, it is flattening. So what two things we have to observe? A, these improvements are sequentially, but when you look at YOY, still they are at the low level. The improvement, what was expected, that kind of improvement is not coming. So I think in the next forecast will give a much worse picture than -5.3, which we have right now.
Right. And with all of this, Mr. Pant, an important aspect that we need to take into consideration is with regards to our restructuring plan is concerned that the RBI has brought out. What they clearly indicated is that the stressed MSME borrowers will be made eligible for restructuring their debt under the existing framework, provided that their accounts with the concerned lender were classified as standard as on March 1st, 2020, and this restructuring will have to be implemented by March 31st, 2021. What would your view be on this step that has been taken by the RBI, for the MSMEs in terms of where restructuring is concerned?
Look, MSME, if you're talking about this monetary policy and the restructuring,
Correct.
not much has changed for MSMEs, because for MSME, 1st March standard means standard will remain 90-day post due date. So basically what we are talking about anyone who hasn't paid post 1st December 2019 will remain a standard account till 1st March, because it will become NPA on the if it crosses 90 days. Only difference for MSME is the timeline has been extended. So the timeline has gone up to 31st March 2021. The major thing which has happened to non-MSMEs. And
Correct. The corporate loans.
non-MSMEs, 1st March 2020, not 30-day overdue. So this is a very important thing to note, not 30-day overdue. So basically what they are saying, anyone who has paid till 30th of January 2020, all right, they will get this benefit. So what they are doing, they are segregating those borrowers where their cash flow or their top line is stressed because of COVID-19, rather than all those who were already under stress in the pre-COVID situation. So there is a clear distinction between COVID-related stress and generalized stress. So any borrower which was under generalized stress, his loan will not be restructured. But those who came under stress, because of COVID-19. So whole idea is, philosophy is, if anyone who was able to manage its cash flow properly before the COVID hit them, they should be given benefit. But the one who was not able to manage their cash flows COVID situation, that is not given the benefit of this restructuring.
Right. So with this, do you think, a step like this is going to help boost the equity markets as well?
Look, equity is a different ball game, entire different ball different.
I know.
Look, what is happening is, and the way we look at the response of the stock market post policy announcement, it is simple. The banks will rather than, so with this, one thing can be assumed: the moratorium is unlikely to be extended. So although he hasn't said openly, it is more likely that the moratorium will not be extended. So whole idea is, all those who has the capacity to pay, those whose balance sheets or whose cash flows are not suffered a great deal, they should continue to pay. That will bring in the more cash to the economy, or to the banks. Although money is already coming to the banks, and you have benefit coming to the other sectors of the economy, and that is what I believe is what equity market is responding. You have to ask an equity analyst rather this question.
Right. So, Mr. Pant, do you think from the banking side as well, the corporate restructuring that we're looking at will be a good step for banks in the long run? However, in the short run, this would actually increase the opaqueness of the asset quality.
Yeah, they will be. They will be. Look, one has to distinguish or segregate the two hits. So there is one hit to the bank's balance sheet, asset quality, cash flow, which is coming from because of the COVID. They were already under stress. So additional equity, public sector banks, whether they will be able to raise equity or how much the government will give them. But along with that, this restructuring, the banks have to provide for, I think, 10% upfront as the equity. Whether banking system as of now has that kind of equity available with them, whether the private sector banks are better off than the public sector banks, one has to look at each individual bank's balance sheet, and then only one will be able to say it. But yes, if there are pressure which are not coming because of asset quality, then you have to provide for the equity now, at least 10%, so that later on, if the restructuring doesn't go the way it is planned, then you have already created some buffer. But no doubt, the equity will be required for the banking sector, for the NBFC sector, and equity is very important at this point of time. Anyone who is able to have more equity, anyone who is able to conserve liquidity will be a winner in medium to long run.
Absolutely. Stands that increase for gold and jewelry. What would this actually mean, and what would your view be on this?
Look, I think that the amount of gold which Indian households own, right, that will be, if not the highest, one of the number. Simply looking at the way the gold rate is per 10 gram, and if a household has, say, 100 gram of gold, so 5.5 lakh, and 15% additional from 75 to 90, So 15% more loan. This is more or the gold loan companies will do, where collateral, because the gold is kept as the collateral. So even if the borrower is not able to repay, they have a collateral borrowing where the collateral is very difficult to convert into gold of 10 tola of gold, they will get another 82,500 rupees. And the banks or the lenders will be able to realize that money. How much of that gold will come out in the market? Because ultimately, though we don't have any estimate how much of that is accounted for, how much of that is unaccounted for. But yes, there will be some benefit. Maybe some households who are under stress, they will be able to make use of it.
Right. And with this, another question I want to ask you is with regards to where bank recapitalization is concerned, how important is that, where the government needs to take a call? Because when the RBI has done a stress test as well, it's clearly showed that the banks are on thin ice on the back of COVID-19, because the report clearly has indicated that moratorium is something which has actually suppressed the real amount of stress on the bank's books, and half of the banking system's loan book was under moratorium as of April itself. So, taking this into consideration, what's your view with regards to recapitalization, and how much do you think would be actually needed?
Well, our banking expert they had done some calculations. I think their estimates was for public sector banks, the requirement will be somewhere between I think 30,000 to 50,000 crore of additional recap requirement because of this COVID stress. So that was the number for public sector banks, just because of additional. So it was over and above what government has already planned for this. So COVID itself will lead to somewhere around 30 to 50,000 additional capital requirement from public sector banks.
Right. And do you think that there will be a need with regards to the monetization of the deficit is concerned by the RBI?
Well, that's a big black box. So let's put number to it. Our estimate is central government fiscal deficit will be 7.6% of the GDP. All right. And that is in line with 5.3% contraction in growth. If 5.3% contraction goes up, then this number is likely to go up. Now, in generally, what people believe is if the fiscal deficit is enlarging, that's a fiscal stimulus given. No, it is not the fiscal stimulus, because a large part of it, almost 90% of it, is coming because of reduction or the lower tax collection because of two reasons: A, slower growth, and B, over optimistic buoyancy estimate which was there in the budget. So 7.6% for the center, 4.5% for the state. Put together, we are looking at 12.1% of the gross borrowing by the center and state. You would take it, the public sector enterprises and all those, we are looking at a staggering number of somewhere around 12 to 13 lakh crore worth of borrowing. Can we finance that internally? Answer is no, because market doesn't have that kind of money, or the savings are not sufficient to finance that. Do we go externally and do the sovereign bonds? the proposal which was mooted in the previous budget, but which was not considered, or which is as of now not on the table, at least from the information available publicly. What is left with is RBI will be doing some sort of, whether they will give some, whether they do direct monetization, because indirect monetization is already happening. All right.
Right.
The RBI does OMO, they earn that interest, and that interest plows back 99% of that goes back to the central government in the form of dividend. I think that will be the last option, and they will try to exhaust all possible alternatives from wherever, and post that, if there is nothing, then that will be the last option. How that will be institutionalized, whether it is direct borrowing in the direct primary market subscription by the RBI for the government bonds, or is it done some other way? But I think that's the bottom line, is they have to do it, but that will be the last option. When it will be exercised, answer is when they will exhaust all other possible sources.
So do you think right now the OMOs that are happening, twist, LTRO, CLTRO measures that have been undertaken, are they enough right now?
You have to repeat it? I lost your voice.
Yeah. No, my question is that currently the RBI has been resorting to OMOs, Operation Twist, LTROs, CLTROs. Do you think as of now these measures are enough?
Look, these are basically, by these measures, what is happening. The major problem with all this issue is because you are flooding short-term liquidity. Now, if you look, your yield curve has become too steep compared to where it was. So all surplus liquidity, ample liquidity, and because of that, your short-term rates have come down drastically. Long terms have also come down, but long terms not that much. So if one looks at traditional sense of 10 year to 3 months, or 10 year to 1 year differential, that gives a very, very huge differential. So TLTRO and all those, that is more a tool whereby they are managing how the interest rates are in the market. Buy short term, give long term, buy short term, give long term, which will over a period of time will help in a way the government's interest payment will also get elongated rather than being compressed in a 2 year or 3 year bucket may increase to 10 year or 30 years. But this as a mode or the tool of deficit financing, unlikely to achieve, because you are taking what you are doing, you are buying, say, the papers which are maturing in FY21, right? And instead of that, you are issuing paper which will be maturing in, say, FY30, right? Now, it is again what I said earlier. Indirectly, it is the RBI financing the deficit, monetizing the deficit. Now, ultimately, round tripping, whether one use that word round tripping or what. So instead of whether the banks or any other fund houses, those who are owning these securities, they are now owned by the RBI. So the interest on these, say for example, if was 6%, that 6% interest, instead of accruing to these holder of the securities, will be given to RBI, and then the RBI will give it back to the government 99% or 99.9% or 100% of it as the dividend. And it is the same thing, but whether that will be deficit financing, the answer is no, because this year's deficit is not being financed by this. TLTRO, LTRO, and all those, they are more a liquidity tool. By that liquidity tool, the borrowers will get some benefit. They will be able to get low cost money at a lower rate. Overall liquidity in the system improves. Because of that, you have the overall interest rate in economy going down, but more on the shorter end of the curve, less on the higher end of the curve, and that is the benefit which is accruing. But that is not what the deficit financing is. It is not doing any deficit financing.
Right. So right now, what's the kind of impact we could be expecting in terms of a bond yield score? Do you think the market yields may inch up a little in the near term, or how do you see the movement? Because no measures in terms of increasing the health to maturity limits or even a OMO calendar is given out, which somewhere does act like a small negative for the bond market. Because normally, whenever the 10-year yields have come around with 6%, RBI has always intervened through MOs or through Operation Twist. And now, if you go to see the old 10-year is trading at almost around 5.95. Taking these points into consideration, how do you see the yield market moving?
Look, right now it is very difficult for RBI, what we feel, to put an OMO calendar. And the reason being the way the capital flows have taken place. Though in Feb, March, April, we had seen the capital flight mainly from the portfolio side taking place. So in Feb, somewhere around $16 billion has gone out. In March, April, somewhere around $1.6 billion has gone out. But if you look at Forex reserve, how that position has changed, there has been somewhere around $55–56 billion worth of entries in foreign exchange reserves. And if you look at the net out, even the gold valuation because of it has gone. So the foreign currency assets, those who are actual dollar or equivalent, that has gone up significantly. Now that $50 billion into 75, right? We are talking about 3.75 trillion worth of rupee liquidity, which is given to the system. Now, when that kind of liquidity is coming in, it becomes very difficult for RBI to put an OMO calendar. Because the moment it puts in OMO calendar, you are again increasing the liquidity in the system.
Absolutely.
Now, what do we want? Do we want the interest rate 10-year to come to 2% or 3% or whatever? So we have to manage these instruments, and these are when the times are difficult or when times are very uncertain, the instrument which has given you good result, say 2 years back, may not be that successful at adverse time or difficult time. Each instrument will give you a different kind of result. So OMO calendar is very difficult to put. And our estimate suggests entire year the forex reserve will go up by somewhere around $65 billion or so. So that kind of money which is coming into the system. LTRO, twist, and all those, they will be all short term depending upon where the issue is. If short term is looking more problematic, they will add whether which 10-year they will target, because states are doing 30 years. The states are getting even at 4.5% for 3-year paper. That kind of number was never heard of. Nobody has imagined that even states will be able to get money, 3-year money at less than 4.5. It is all because of ample liquidity in the system. And that liquidity, though they have and even it is, if you look at the stance, the accommodative stance says this only, but the kind of liquidity will remain in the system. And that is what they are going to do. They will use whichever instrument, whenever it is required. The target, if they are targeting at the shorter end, they may do twist. They're targeting and somewhere at 5 to 8 years, may use another instrument, 10 years, different instrument.
Right. So very lastly, Mr. Pant, if you have to sum up the entire policy today, the NPC has maintained the status quo. Their stance has remained accommodative. The loan restructuring for MSMEs, for corporate loans as well. They've said that inflation continues to remain in focus. The growth outlook is really somber this time. And the resolution framework of COVID-19 related threats is something that the RBI has spoken about, and the increase in permissible loans against gold ornaments and jewelry, as well as additional liquidity facility for NHB as well as NABARD. Now, if you have to sum up all of the announcements that have come in, do you think the policy announcement is pretty much on expected lines? And this is exactly what the markets were looking for.
Yeah, they have tried to tick all boxes what was required. Uh,
Mm,
but at the same time, look, if say the corporate restructuring, now it is already given to the banks. Okay, here is a structure restructuring which is available. You may get a benefit out of it, but keep your 10% of it in the provisioning. So it
right.
has tried to do. There will be no policy anywhere in this world, any central bank, anywhere which will satisfy all market players or which will satisfy all analysts. Because what will happen, like I will look at it from the narrow angle of the areas or sector I am operating in. So
Right.
see the growth supporting, people will say, oh, he could have a reduced interest rate. So simple question is, had even the interest rate is reduced by 50 bips, whether Hiral
Mm,
is going to borrow and consume, or whether Devendra Pant is going to borrow and consume? The short answer is no. Then why should that precious rate cut be wasted at a time when it is not going to give you result? So it has tried to
absolutely.
tick most of the boxes, and but only thing is all those who are perpetually into cash flow problem, there is nothing. And whether those people should be supported, those corporate should be supported, those who are already always in the perpetually in the cash flow mismatch problem, all those where the business model is an issue, where the business is not viable, whether those should be supported or not. So that's a different issue. Everybody will have a different opinion, but it has tried to tick all the boxes.
Absolutely. So majority of the boxes that have been ticked by the RBI. Thank you, Mr. Pant. Thank you so much for joining us at Nirmal Bank. It was a pleasure to have you. Great insights and great understandings that we picked up from you as well. I hope you have enjoyed the discussion as well, and we will see you back soon again. And stay safe. Thank you so much.